Hi, welcome to the video series on Warren Buffett shareholder letters. Before I begin, let me remind you, if you are watching this video for the first time, it is recommended that you go back and have a look at our introduction video because that talks through what we want to achieve in these sessions. Now, over to today's session. Today we're going to talk through the 1964 letter which Warren Buffett wrote to his partnership members. Now, what I really want you to take away from this letter, which I've got with me here, are five important lessons from the 1964 letter. Now, over to the first lesson which we got from the 1964 letter. The first one was a very simple one. Stick to the yardstick. I'll repeat. Stick to the yardstick that you have set for your performance evaluation in terms of investing. Now, if you have set that your investing goal is to beat the indices by 5% year on year for next 5 years, don't change that yardstick every year on your convenience, because then you won't be doing your performance evaluation in a correct manner. It's a very simple message, but a lot of us tend to ignore it. We tend to go in a convenient manner and see and beguile ourselves that we are doing really well when we are actually not. So that was a very short and very important lesson which we got from the 64 letter. The second one was around why mutual fund industry, because you remember that Warren Buffett always used to compare his performance not only against Dow but the leading mutual fund players in the US at that point of time, and he clearly pointed out there were five reasons why mutual fund industry was not doing even not doing well, and as well as not beating Dow at that point of time. And those five reasons he is clearly pointed out in his letter, and I'll probably go through them. The first one was around the group thing. So everyone was thinking alive. There was no unconventionality in terms of picking stocks or companies where the mutual fund is going to invest. So that was one of the reasons why everybody was getting average results. So if everybody is going to put money in Reliance, end of the day, you would get as good as what Reliance is doing. So that was the first thing. Second thing was everybody wanted to conform to a policy. So a mutual fund generally have restrictions on market caps which you can invest in. So if a company is really doing well but it's only a 500 crore company or a $500 million company, you won't be able to invest in it because your fund says that you can only invest when it becomes a $100 million company or $1 billion company. So that sounds to be weird because you're waiting for the market cap to go up so that you can start buying into those companies, but that's how the mutual fund industry operates. The third thing was there was a framework, the institutional framework, and which was that the average is safe if you're able to still keep your returns in tune to what the indices were running. You would never be thrown out of your job. Now, we as individuals as well, we also tend to get into this safe and comfort zone that if we are performing on an average level, nobody is going to throw us out from our current jobs or from our current work, and that's really a wrong mentality to get into. We always need to strive for our best and don't settle for average. Now, the other thing which he was saying was, because the mutual funds diversify too much, so they put 2% here, 1% here, 5% here, 7% here, 9% here, that's not going to work out. So if you have got real conviction, if you've got real understanding of business and valuation, you would tend to put a larger sum into that company to get maximum benefit out of it. And finally, he thought that there's a lot of inertia. A lot of people were not willing to go and make that move and get the returns for their unit holders. So again, I don't know if that was a qualifying statement and whether I agree to it or not, but those were the five things which Warren Buffett pointed out, which were the reasons why the mutual funds were not doing well or were not able to beat even Dow Jones at that point of time. The third thing which we got was his view on conservatism. So a lot of the people think that because he was investing in small companies, he was investing in situations where he was going to liquidate the company or he's going to ask for a spin-off. He was doing a risky business. He was running a risky partnership. Now Warren Buffett countered that point, and I think there are very beautiful lines that he has wrote around conservatism, and I would quote him from the letter itself. He says that truly conservative actions arise from intelligent hypothesis, correct facts, and sound reasoning. These qualities may lead to conventional acts, but there have been many times where they have led to unorthodoxy. In some corner of the world, they are probably still holding regular meetings of the Flat Earth Society. So he's saying that when your reasoning is right, when your hypothesis is correct, that is where you are really conservative in your investment. Not because you're investing in the biggest blue chip in the index, or when you're investing in where everyone else is investing. That's not your definition of conservatism as per Warren Buffett. His definition was very clear. And he also put another line, again I need to quote it. It says that a public opinion poll is no substitute for thought. So if everybody is saying it, that does not mean it needs to be correct. And he really spelt out that true conservatism is really reflected in the returns that you get in a bear market. And in this letter he pointed out that in the 3 years where Dow Jones was down for about 20% on a compounded basis, everybody in the mutual fund industry had a negative return, and he had a return of 45% plus. So he was not boasting about his return, but he was saying that if you really want to test how conservative a fund is, see what kind of returns they have given when the markets were not going well. So again, a true test of conservatism we could get from the man himself. So that was another important point. Now the another important point was, you remember our earlier letter where we have said that his state of operations were divided into 3 types of securities: the journals, the workouts, and the control situation. Now for the very first time in the 1964 letter, he split out the journals into 2. What were those 2? The first one was journals which were on private owner basis, and the second ones were journals which were relatively undervalued. Now Warren Buffett took pains to make his readers understand what was the difference between these 2. And again, let me go back to the letter itself to try and give you a flavor of what journal private owner basis meant. So journals private owner basis meant they were undervalued stocks, obviously, and they were determined by quantitative standards. So obviously he had his book value and what amount of cash and other things which were there in the company. But considerable attention was also paid to qualitative factors. So he was really putting a lot of emphasis on what business that they are trying to acquire, what kind of management that they have, what kind of industry they are operating in, apart from all the quantitative factors which for his journals which were on private owner basis. The reason was they would in a very large proportion would either turn into control situations where they will acquire the controlling stake in that company, or even if this does not become a control situation, if the market turned favorably, they would sell out, like in your other type of securities. But he really pointed out that those journals had to be attractive to a new private owner, and those were the companies which would fall under journals private owner basis. Now, how did he distinguish those with the journals which were relatively undervalued? Now, this category of securities were again selling relatively cheap. However, they do not need to value them on a private owner basis. The reason was these were large companies, and they were having and the current valuation, by their current valuation standards, it would have been a misjudgment on Warren's side to value them as on a private owner basis. So again, a very key learning from you cannot apply a single valuation method to every company that you are trying to evaluate. And second thing is, a lot of people tend to get confused with Warren Buffett's style of valuation, that they would try to put a private owner basis valuation for everything that they get their hand on. Here in this letter, he is clearly demarcated these two. When you are having a large company and there was a situation where an undervaluation was there because of many reasons. And he's really used the word relatively. He's saying that relatively to that company, other companies in the same sectors were valued fairly. So in that situation, he used the relative undervaluation method to value that company, while on other situations where they wanted to, they had a significant portion of assets under their control, where a relatively private owner basis is going to get into a control situation. To really summarize and get it in simple terms, if they were trying to acquire a major portion of a company, they were looking at private owner basis as the method of valuation. No hard and fast rule, but that's my take. And the second thing was, if they were looking at really an underpriced security for the undervaluation to catch up, and then they are able to sell out, they were really looking at relatively undervalued concept. So that was another important concept which was introduced to us in the 1964 letter. And again, I would highly recommend you guys to go back and look at these 4 or 5 paragraphs which were dedicated to these two items in the letter. The final thing which we got from the 1964 letter was, Warren Buffett recommends that don't look at what prices were there for past 5 years, 7 years, 10 years for that company. Look at what was the past operating history, how did the business perform over business cycles. And he really had an interesting quote in this letter, which I would read out to you guys. He's saying that it is obvious that performance of a stock last year or last month is no reason per se to either own it or not own it now. Now what he's doing is he's taking a pot shot at technical analysis. What he's saying is, don't look at the chart pattern of the stock, what it has done in last month or last year. Think about how business has performed over last year, and does the business merit the price which the market is asking at this point of time, instead of looking at the past price behavior history of the company. This was really important. And again, a lot of technical analysts, my friends who are watching this video, will not agree with me, but this is what Warren Buffett was trying to convey. Continuing, he said it is obvious that inability to get even in security that has declined is of no importance. It is obvious that inner warm glow that results from having held a winner last year is of no importance in making a decision or whether it belongs to an optimum portfolio this year or not. So very simply, if you had a winner in your portfolio, and but if you are trying to optimize your portfolio, because it was a winner last year does not mean that you need to keep them in your portfolio this year. Understand the business situation and then take a call whether they really need to be in the portfolio or not. So those were the 5 key lessons which we got from the 1964 letter. Hopefully you'll get more key takeaways when you actually read the letter. I would highly recommend you to read the section on how he has split the journals into ones which were valued on private owner basis and the ones which were used on the really valued on the relatively undervalued securities. So that was my learnings and my takeaways from the 1964 letter. Hope you have liked it. If you are liking this series, do hit the subscribe button. Thanks for watching, and I'll see you again.